Let's start with the fundamental accounting assumptions. What assumptions I make before recording any transactions into my books of accounts. Small assumptions, and no need to learn these assumptions, just understand. First is going concern assumption. As the name suggests, going concern. I have no intention to shut my business down in near future. My business will keep on going is the assumption made here by every business until and unless something very drastically happens that I have to shut down my business on regular basis. The assumption is I have no intention to close down my business in near future. See, in one line, this is the crux of going concern assumption. That is why we even differentiate between capital expenditure and revenue expenditure. It is a going concern. So the revenue should be part of your P&L, and the capital expenses are generally part of your balance sheet. Why so? Because my business will keep on going. When I differentiate between those two expenses, I get a true picture. So now the next assumption, consistency assumption. Okay, what is consistency assumptions? One accounting practice which is adopted or selected by the organization, they will keep on applying it over year. This is consistency. Consistently I apply a method of accounting over years. This is why consistency assumption. I will give you an example. Say for depreciation, there are two methods. One is straight line method and one is written down value method. So if I select WDV as my method in books of accounts, I will not do this year WDV, next year SLM, then next year WDV, then WDV, then SLM, anything what I want. No, once I have selected WDV, I will keep on selecting it in coming financial years until and unless there is some law come or something which requires to change the method for a better presentation. Until and unless something like this happens, I will consistently follow the methods which I have kept on following, so that it shows a correct picture of my accounts. Okay, coming on to the next assumption, the accrual assumptions. Now what is the accrual assumption? When it tells you when to record a transaction in books of your accounts. Record a transaction. When do you record it? This answer is given by the accrual assumption. At the time when it is entered. When? At the time when it is entered, or at the time when the settlement takes place. At time of settlement. So the answer is when you enter and you have a binding contract or a legal contract made, you have to record it then and there. Don't wait for the settlement to record it in your books of accounts. I will give you an example. I purchased goods on credit, say 50,000 rupees on 1st January, and I paid them on 31st January. So I purchased on 1st January and I paid them on 31st January. My account gets settled on 31st January and I entered into a transaction on 1st January when I made a binding contract to pay. Okay, and an invoice was generated, a tax invoice was generated in my name. So the contract is done here, but it is not settled till I pay. So the effective date of transaction or the date on which I will record it in my books is 1st January, and it is not 31st January when I pay. So this is the accrual assumption. So three main assumptions: going concern assumption, my business is not going to close down in near future; consistency assumptions, one method which I have followed, I will keep on following that method consistently in my books of accounts. Not that if there are two methods allowed by accounting, I will keep on changing. That is not allowed. And accrual assumption, I record any transaction in my books of accounts when it is entered and not when it is settled, subject to all the legal and contractual things that has to be taken. If there is a binding contract, then record it in your books of accounts when it is entered.